Hello, I'm Carolyn Herbert from the Finance News Network, and joining me at the 2017 SMSF Summit in Sydney is COO and Head of Advice at Spring Financial Group, Frank Paul. Frank, welcome.
Thank you for having me.
Now, what is your key takeaway message for SMSF trustees?
I would say the key takeaway message is that by and large the majority of the changes are positive changes to the superannuation system. I think it will give trustees some certainty for at least a few years to come. I know that politicians have been tempted to make changes to super on and off over the years, but I think this round of changes on balance is positive and is unlikely to bring in any major changes for quite a while, so that's a positive.
So what are some of the key changes to super that trustees can benefit from?
I think the main change is that concessional contributions can be accessed in a different way going forward. It's an underreported change, and it's a change that I like talking about quite a bit, because right now an employed, salaried person can only access concessional contributions through sometimes convoluted and complicated salary sacrifice arrangements. And employers are actually allowed not to offer it. If an employer doesn't want to offer a salary sacrifice arrangement, then it is what it is. That is being abolished now from July of this year. So an employee, and the vast majority of people in this country are employed, can make a cash contributions into super at any time during the year and claim it as a tax deduction. So I think that's actually a major change. On the flip side, there's obviously a reduction in caps on the concessional side and on the non-concessional side, but that's not going to affect too many people. Most people to date haven't been able to take advantage of the current caps. So it is a reduction. It's a negative for some, but on balance won't affect the majority.
So saying that, where do you see the best opportunities?
From an investment perspective?
Yes.
Look, I think all the markets have opportunities embedded within them. Bonds remain expensive, have been for quite a while. I don't think that's changing anytime soon. There are some good fixed income opportunities in the market, but classical bonds per se are quite expensive. The real estate market, well, there is no single market. There's hundreds and hundreds of sub-markets. Some of them are expensive. We know what Sydney's like. Other markets are probably at a point in their cycle where they're really good value. Brisbane potentially is at that level. There's great opportunities in Melbourne. So, and equities continue to pay out really good levels of dividend and franking credits. So in truth, there remains, in this low interest rate environment that we're in, there's actually a lot of opportunity for investors to get a better return, an improved return than what a risk-free bank account can offer them.
And on the residential property market a bit more, as you say, it is fragmented at the moment, with some states being much more expensive than others. So is it still attractive, and what do trustees need to consider?
SMSF trustees by nature are long-term creatures. A self-managed super fund is a long-term vehicle. Retirement and the planning for retirement often is a decade or multi-decade affair. Now, the vast majority of people who've made money out of real estate over the years have made it by buying and holding it for long periods of time. And I think there's a good fit between the natural timeline of an SMSF trustee, they're long-term investors, and the timeline required to make money out of residential real estate. And so if you take a long-term view, in many of the markets in Australia at the moment, I think the opportunity to make money is good and remains good.
Frank Paul, thanks for joining us.
Thank you.